how to be approved for a commercial mortgage. I've been answering this question for about 20 years, so hopefully you find this video or this podcast episode really helpful. And so there's a couple basic things that you need to know before you get too far. First of all, not every bank is the same. Every bank generally wants to know the same thing, but specifically will approve you for different reasons. As an example, some banks love certain industries and markets, while other banks don't want to touch those industries or those markets. So for example, some restaurants are able to go to certain banks to get approved. Other restaurants need to stay away from certain banks because they're just not interested. Heavy duty mechanic shops or dry cleaning businesses typically might be approved by one bank or lender, but not by another. Now you might be asking me, why am I using the terms bank and lender? Because banks and lenders are different things when it comes to getting financing. A bank is typically a regulated financial institution, whereas a lender can be a non-regulated financial institution. It can be a group of people that have put their money together to lend it to businesses, and they take mortgages back as security. They can be trust companies, they can be venture capital firms, they can be anything except a bank. So I use the term bank and lender so that you understand that there's different categories. There are your traditional banks, which are going to give you the best interest rates possible. But then there are also lenders, mid-market lenders and private lenders that will do business that the banks won't do, but they're going to charge you higher interest rates and higher fees for doing it. So every bank generally wants to know the same thing, but will approve you based on different specific criteria. So that's the first thing you need to know. So here, what do they want to know? They want to know, can you afford to make the payments? And they want to know that your history, some historical evidence, 2 years, 3 years of financial statements, prove that you're able to make the payments. The second thing they're going to want to know, before I forget, they're going to want to look at it based on history, not on your hopes for the future, because they can't put that in a spreadsheet and have a great degree of confidence in it. So they're going to look at your history to try and figure out, has there historically been enough money to be able to make this kind of a payment? Not, is there going to be money in the future? If there is money in the future, great, that's wonderful, but we're basing our decision on history. Second thing they're going to want to know is, are there enough assets to cover our loan balance? And here's where it gets a little tricky. You may have assets of equipment or real estate or something that are worth $100,000. The bank isn't going to lend you $100,000 because their assumption is the day they give you the money, they have to go and get it back because something goes wrong. That means they have to sell assets for less than what they're worth in a fire sale or a receivership or a bankruptcy situation. So they never lend you the maximum amount of the value that your particular asset might have. So when looking to get approved for a commercial mortgage, it's important to understand that they're going to be looking at the income historically, and they're going to be looking at the value of the property. Now there's the property plus the other assets that you have. They want to make sure that their loan balance can be covered. Sometimes, most times, the loan balance is covered by the property itself. But sometimes when you need additional money, they're going to look to some other of your assets as a way to make sure that if the primary security that they have doesn't really work out, they can go after some of your other assets and get their loan balance back in full. So that's basically it. Can you afford it, and is the security there? Now, every lender is going to look at these things a little bit differently. You may say to yourself, historically, our business has made $500,000. The bank might say, great, we're going to assume you make $300,000, and then we're going to see if you can still afford the payments. You might say, look, my assets are collectively worth $3 million. The bank will say, great, we're going to lend you 1.5. So every bank is going to have a bit of a different basis upon which they want to approve you and the criteria upon which they're prepared to do it. So I always like to say that every bank says yes at some point. You can get a deal. Every single deal can be done to a certain point. Now, you may not get the amount you're looking for. You may not get the interest rate you're looking for. You may not get the fee structure that you're looking for, but every deal can be approved, technically. But practically, it does require some work, and it does require some help to make sure that the mortgage you want, that someone's able to converse with the banker and make sure that that is in fact what you get. So those are the big things. When it comes down to the category of lender, I mentioned there are banks that will give you the best interest rates possible, but they're also going to be the hardest people to get the money from. Then there are two other kinds of categories, or two other groupings of lenders that we typically refer to: mid-market lenders and private lenders. Mid-market lenders are pension funds or private or rather pension funds or insurance companies or trust companies that are not banks. So they don't do bank quality. They're just outside of banks. So they'll do the stuff that the bank won't approve up to a certain point, and they'll charge a little bit of a higher interest rate for it, a little bit higher fees, and they'll relax on the security a little bit. And then the last group is private lenders, which are typically investment firms or private individuals that lend their money at higher interest rates, higher fees, because they're prepared to take the risk that the mid-market lenders and the traditional lenders won't take. So you've got three different categories of bankers that you've got to consider when you're going to get a commercial mortgage. Another big criteria that you'll want to keep in mind is the bank's going to want to know, is this commercial mortgage for your business? Because if it is, we've got different criteria for that. Versus, is this commercial mortgage for a commercial property that you're just going to own and rent out to other people, because we consider that an investment property, and therefore we have different criteria for that. So again, there's lots of specific detail that I can go into that talks about if it's land development versus construction, versus you're buying an old space and you're fixing it up for your business, or you've just taken over a space but you want to completely gut it and make it more customized to what your business needs. So there's lots of other details underneath this, but it's helpful to know what are the big pieces that the bank is going to want to know, and as a borrower, what are some of the big pieces that you want to know. So hopefully you found this helpful. Make sure to drop me a comment, send me an email, let us know how we can help you with your specific criteria that you're looking to address, and we'd be happy to do so. So thanks for tuning in, and we'll catch you on the next video.